As we look at the live market right now on July 22, 2026, Nokia OYJ stock is trading at $10.35, down roughly 2.68% during today's session as trading volume ticks above 30 million shares. The stock opened at $10.24, moving between an intraday low of $10.20 and a high of $10.48. If you have been tracking this ticker across popular retail platforms like the Robinhood app or through your individual brokerage account, you might look at this steady pullback today and assume it is just another sleepy telecom hardware maker slumping ahead of earnings. But beneath that quiet price action lies a dramatic shift in how the broader market is pricing this legacy giant. Wall Street spent years treating this company as nothing more than a slow-growth cyclical utility tied strictly to carrier cell tower upgrades. The reality unfolding right now, however, tells a completely different story. Behind the scenes, institutional money is quietly positioning around a massive structural pivot toward high-speed optical networking, artificial intelligence data center interconnects, and agentic AI management platforms. While retail traders on platforms like SoFi Invest or Fidelity Investments are distracted by mega-cap volatility in names like Tesla stock, Apple stock, or Nvidia stock, institutional desks on Interactive Brokers are executing strategic positions in Nokia ahead of tomorrow's morning's second quarter financial results. The narrative standard in retail circles is that network infrastructure is a dead end because telecom operators have dialed back their traditional fifth-generation wireless capital expenditures. Market sentiment often paints this enterprise as a lagging relic of past mobile phone dominance. Yet, if you challenge that standard belief with a look at trading activity over the last 12 months, the stock has actually posted a gain exceeding 100%, dramatically outperforming sector rivals. Over the past few weeks, daily swings have intensified as option volumes expanded across major trading channels. Investors utilizing self-investing tools or automated allocations like Schwab Intelligent Portfolios are noticing that Nokia has steadily re-rated from its 52-week low of $4 all the way up toward a recent high near $17. Today's slight drop reflects a classic pre-earnings hesitation where short-term traders take profits after a massive multi-month run while institutional funds recalibrate their exposure. Understanding this recent price action requires looking directly at the macro forces moving capital through online investment channels. The current consensus revenue target for the upcoming second quarter report sits near $5.59 billion, with expected earnings of 7 cents per share. But the real driver of volume on the Interactive Brokers platform and within Fidelity Wealth Management portfolios is not just the baseline quarter numbers, it is the acceleration of non-telecom enterprise demand. Enterprise order books have expanded rapidly as cloud hyperscalers desperately seek custom optical switches and ultra-low latency routing to link massive graphics processing clusters. When tech platforms build out computing clusters requiring thousands of GPUs, the physical bandwidth bottlenecks become severe. That is where optical networking becomes an essential necessity. Traders taking advantage of Robinhood fractional shares or active trading features on the SoFi trading platform are seeing that Nokia is no longer just selling base stations to wireless carriers. It is supplying critical infrastructure to the very data centers driving the broader tech boom. Take a moment right now and comment below how many shares of Nokia stock you currently hold in your portfolio, or tell me if you are looking to buy ahead of this earnings report. To properly evaluate if current prices are justified, we have to contrast the public market expectation against operational reality. The public market expectation views this company through the lens of history, expecting sluggish single-digit revenue expansion, burdened by intense price competition from global legacy vendors. The operational reality, however, shows a business model that has undergone a sharp, quiet restructuring. The core operations now span 4 primary units: network infrastructure, mobile networks, cloud and network services, and Nokia technologies. Network infrastructure focuses on optical backbones, fixed submarine networks, and IP routing. Mobile networks provides commercial radio access network equipment, including open architectures and cloud-native solutions. Cloud and network services delivers software automation, including newly introduced agentic frameworks that allow network software to self-optimize and manage data traffic autonomously. Finally, Nokia Technologies manages a world-class patent portfolio containing over 20,000 patent families, including roughly 7,000 patents critical to global wireless connectivity standards. This intellectual property segment generates high-margin licensing royalties that inject consistent cash flow directly onto the balance sheet. This legal and technological moat gives the enterprise incredible resilience during periods when telecom carrier spending slows down. While investors using Robinhood stock trading or checking Fidelity mutual funds often lump all hardware vendors together, this licensing engine provides a margin cushion that pure-play hardware competitors simply do not possess. In recent quarters, licensing agreements signed with major smartphone manufacturers and consumer electronics producers have locked in long-term predictable revenue streams. Furthermore, the launch of specialized innovation laboratories partnering with silicon powerhouses like AMD, Lenovo, Supermicro, Keysight, and Viavi has opened direct sales pipelines into enterprise data centers. By designing specialized switching gear built specifically for high-density compute environments, the company is directly challenging specialized data center hardware suppliers. When you browse popular investing sites or evaluate option strategies on an Interactive Brokers account, the valuation metrics present an interesting dilemma. On a trailing earnings basis, the price-to-earnings ratio appears elevated compared to historic industry averages. However, forward-looking consensus models tracked by analysts on Fidelity Investments and Robinhood Investments suggest that earnings per share could expand significantly over the next 2 fiscal years, as high-margin software and optical shipments represent a larger percentage of total revenue. This prospective margin expansion is why several major Wall Street research desks, including J.P. Morgan and Bank of America, have maintained strong buy ratings with target prices reaching well above current trading levels. Yet, any rigorous analysis must account for downside risks and real-world pressures. The primary threat to this bullish thesis stems from the cyclical nature of service provider capital budgets. If major telecom operators delay their network modernization programs due to macroeconomic tightening or elevated interest rates, revenue in the mobile networks division can experience sharp pullbacks. Additionally, breaking deeper into the cloud data center switching space puts the firm in direct competition with established market leaders that enjoy deep relationships with major cloud providers. Execution missteps in ramping up production or supply chain disruptions could hinder margin progress. Currency fluctuations across international operations also introduce earnings volatility, given that a significant portion of international sales are denominated in foreign currencies. For retail investors managing self-directed accounts through SoFi Active Investing, Robinhood Cash Management, or traditional Fidelity IRAs, navigating these dynamic market shifts requires a balanced perspective. Utilizing an intelligent portfolio or seeking disciplined investment help can help put individual stock swings into broader context. Online investing is rarely as simple as buying a household brand name and holding blindly. It demands constant reevaluation of how market sentiment aligns with operational metrics. Whether you perform your analysis using the Fidelity mobile app, the Robinhood app, or an advanced Interactive Brokers trading interface, tracking institutional accumulation patterns alongside quarterly order intake figures is essential for identifying true long-term value. Looking ahead, the central story for Nokia is the gap between past perceptions and future capabilities.
Wall Street long viewed this business as a slow, capital-intensive equipment maker tied to the spending mood of regional phone carriers. The emerging reality shows a nimble, software-enriched network partner positioning itself at the absolute heart of global data transportation and AI computing clusters. Today's price action at $10.35 reflects short-term pre-earnings positioning and broad market noise. The true long-term trajectory will be decided by how effectively management converts its massive patent portfolio and optical technology into high-margin enterprise market share. Expect volatility as quarterly earnings hit the tape tomorrow, but keep your eyes locked on the structural transition from legacy telecom to high-speed data infrastructure. Expectations may still treat this stock as yesterday's telecom vendor, but the underlying operational reality suggests a company building the digital